Today we have Ryan Herbert and Lawrence Kiley, and we're talking through some of the issues of retirement. And guys, as I'm looking through some financial news, and I always pay close attention to what financial advisors are doing and how they're helping us plan for retirement, I found this pretty interesting. New study out there about financial advisors, and the question is, have you been changing the way you're planning for retirement and planning for your clients because of the current economy? 65% of the financial advisors said, yes, we are. And by the way, many of them are using a brand new strategy that they have not ever used in their life, an annuity. I thought that was pretty funny. So tell me, Ryan, why would all these advisors be using annuities now and maybe 10 years ago they didn't even consider it?
Well, I would say that the study is interesting because only 65% of them said, yeah, we're doing things differently. What the heck are the other 35%? No, we're just going to sit, buy and hold. That's it. We're not going to make any changes. I'm just going to make the same amount of money I'm making. I'm going to do the same exact thing and not make any changes because, nothing ever changes. The world hasn't changed, in the past 10, 15, 20 years. But, wow. I think that the big thing, annuities are becoming much more commonplace. It used to be, I started in the industry back when I was in college. I started with Merrill Lynch. That was back in 2004. Left Merrill Lynch, went to work for T. Rowe Price. I think I left T. Rowe Price in November of 2007. So, right before the big market crash, I left there and I came here to Prostatis, and I've been here ever since then. And, it used to be that, I had heard of annuities. I'd never really used them before. We used them very, very sparingly, from 2007 to I think about 2011. And then 2011, index annuities became a very, useful tool, a very popular tool. I started seeing more and more of them. Not many people use annuities. Annuities have a bad rep because of the history of them. Annuity salespeople have that same reputation as a used car salesperson. It's the old bait and switch, strings attached, all that thing. And, certainly variable annuities, while there probably are some decent ones out there, for the majority of them, they cost a large amount in fees. Normally you're paying somewhere between 3 to 5.5% to own these variable annuities, which are essentially just, basically mutual funds offered through an insurance company. You're paying all this extra money for something you could get outside cheaper. There are strings attached. You put your money in, you can't get it out for 10 years. The illustrations that these things would be sold on would show that you're going to get these massive, great returns because it's predicting the market's going to do 10% per year. And they never really worked out the way people thought they were because the market didn't perform the way that was illustrated, and the fees are just there. But now, index annuities have become much more commonplace. And, back in 2011, when people came in to see us, either from the radio show that we were doing back then or from workshops or webinars that we were doing, not many people had them. They were these, it's this new thing. We really talked about using them to help create income for people. I want to have a reliable income stream in retirement that's going to pay me 2, 3, 4, 5,000, whatever the monthly income number is. One of the ways you can accomplish that is using an annuity. And, flash forward now, almost 20 years later, pretty much everybody, right? I would say, Lawrence, pretty much everybody who comes into my office has an annuity of varying dollar amounts, varying product, varying type, varying, purpose of them, but they have become such more commonplace because they have become such a better tool. These index annuities out there, there's all different kinds of them, but the name of the game when it comes to retirement planning, I think in the industry is kind of this race to zero, the race to do things in as low cost as possible. We saw it a number of years ago when Fidelity and Schwab and E-Trade and all those other brokers cut all the costs for all their funds, all the trading costs to zero to try and, attract more customers. And, the good thing about the index annuities is, the fees are low. Normally, you're talking 1.5%, I think is the most that I have seen on one, all the way down to like 0.5%, even zero fee for some of them, depending on, if you're adding features. But, the thing to use annuities, well, I think that a lot of advisors are now using them more and more inside of client accounts, or using more and more for their own personal retirements. Is what you're doing is you're transferring the risk of your retirement. When you buy a house, you get homeowners insurance. You're transferring the risk to an insurance company that if something happens to your house, you don't have to pay out of pocket a large dollar amount. You're transferring that risk to the insurance company. You do the exact same thing with health insurance. Something happens to me medically, I'm transferring that risk that this insurance company is going to pay for whatever I need. You do the same thing with life insurance. I want to leave behind a legacy, but I don't want to have to, penny pinch and save my money, in retirement. I'm transferring the risk for life insurance. Why not do the same exact thing when it comes to your retirement? You have taken on all the risk all these years. You've been putting money away inside your 401k. You've been putting money in a Roth IRA, putting money in a brokerage account, and saving money and seeing all these ups and downs of the markets. Why take the risk of possibly running out of money in retirement? Why take the risk of worrying whether the stock market's going to go up 2 or 3% today or down 2 or 3% today, and transfer that risk? Take a certain amount of money. If I look at how much I'm bringing in from Social Security, if I'm lucky enough to have a pension, I have rental income, whatever your sources of income are in retirement, because it varies for everybody. If you have that shortfall, why not take a look at an annuity that says, okay, I can take X amount of dollars from my retirement plan and give it to this insurance company, transfer all the risk to them. And they're saying in exchange for that, they're going to pay me this $2,000, $3,000, $5,000, whatever the number is. They're going to pay me this income stream for the rest of my life. If I'm married, the rest of my spouse's life. And if there's anything left over in that account when I pass away, potentially there is, that money goes to my kids. So, it is an option out there. And, the sheer fact that 35% of advisors, according to this study, are not open to using these new ideas really just kind of puts the question of, is my advisor doing things that are the correct thing for me? Are they showing me all the options that are out there and available to me, or are they just stuck in their ways?
So, Lawrence, as the interest rates have gone up, this has made annuities much more widely known and used out there. Every month, it seems like they set new records on annuity sales in this country, and have been over the last 4 years. But as you sit down with people and you say, okay, we need to build income here, and they go, how are we going to do it? And you introduce the idea of an annuity. I mean, what's the reaction? I mean, do you get the Home Alone face? I mean, what happens when you say that word? Is it, okay, I'm interested, or I've heard bad things? What do you get?
It's a little bit of both, but it's really, when it comes down to the numbers, it's showing, as fiduciaries, we want to show you your options when it comes to how we produce income for you in retirement. So when we are going through the plan and the income need and how we can potentially produce those income streams for you, we'll present you and we'll show you a bunch of different options that you have. One is using the overall market, a dividend producing portfolio. One may be using another dividend type of producing portfolio using preferred stocks. And then we'll also show you the option with an annuity and what that looks like, what the pros and cons of each one is, so that you can make the best decision that works for you and your family. But really what it comes down to, when people see the annuity number and why it makes so much sense for those, is because when we look at the different scenarios and how we produce income, it's really, we want to use the least amount of your overall portfolio to generate the income that you need. And when we look at what a dividend producing portfolio of all equities is compared to a preferred stock portfolio, normally we have to use a bigger chunk of that portfolio to produce the exact same amount of income that we would need, and a much lesser amount of the overall portfolio when using an annuity. So essentially, it's almost costing you less to produce the exact same amount of income, because the goal for retirement is we want to produce the income we need, but that way we have a lot more extra money that can be invested for growth or conservative. It doesn't really matter, because at that point we have the income set up properly. So really it's just looking at the numbers on paper and saying, this is how much of my portfolio would take to generate this dollar amount, versus this is how much it would take to generate that exact same dollar amount. So a lot of times the surprise comes with, oh, wow, I only need to put in this much money to produce this amount of income in retirement by using annuity versus if I put it in a dividend producing stock and it's taking up half or a third of my portfolio value. I'd rather have more extra money for emergencies and spending and fun stuff rather than having to lock that all up for income. So that's where an annuity becomes very, very attractive to the people that come in from the radio show, because they say, oh, I only need to use a smaller portion of my overall portfolio that I've saved to make sure that I have the income coming in consistently and securely to me for the rest of my life. That way, if something does happen, I know regardless of what the market's doing, I have that income coming in to me. If the market goes down 20%, I don't have to all of a sudden say, hey, honey, we can't go out to dinner this week, or we're not going on vacation this year. We can still do that because the income that we wanted and had planned for retirement is still going to come in regardless of what the market's doing, because we've set up that income bucket. We've set up that annuity. We have Social Security coming in, but we've secured it with an annuity, and we took a less amount of our overall portfolio to do that. So that's why that becomes so attractive to people that come into us.
So, Lawrence, I have an iPhone, and somewhere along the line, I don't know if I ever had an iPhone 1, but there was an iPhone 1. And now there's an iPhone 16 or 17. That's where we are now. If you compared the iPhone 1 to the iPhone 17, there would be a lot of difference there. There would be a lot of advancements there. Can we say also that within the financial industry and in the annuity industry, there's probably been a lot of advancements? Because this whole thing about annuities are bad. Maybe they're talking about the annuities of years ago, and they're not talking about what is offered today.
Yeah, that's exactly right. There's been a lot of changes. I mean, Ryan referred to it, with variable annuities and the cost of that, and now with fixed index annuities, there's been a lot of changes where fees are less, where we're capturing the upside of the market with downside protection. So there's been a lot of advancements. There's a lot of with being a fiduciary, what is the reason we're using the annuity, right? We don't want to just buy an annuity to buy an annuity, which is what was happening in the past and why annuities got such a bad rep. We want to use it for a very specific goal or reason, whether that's as part of the fixed income side of the portfolio, where again, market upside that we're capturing without that downside risk, protection. Are we using it for that reason and using a fixed index annuity for that reason? Or are we using a fixed index income annuity where we want to generate income and a very specific income amount? Not just saying, we can generate you 100,000 and let's throw all this money into it, but we want to hit a specific target. What is the number you actually need, and what is the minimum amount we need to put in there to generate that income for you when we want to elect the income? So we're very, very specific in what we're trying to accomplish with the annuities, which is different from just selling annuities just to sell annuities.
There's a lot of different ways to generate income in retirement. Don't you want to look at all that's out there and see what's right for you? And maybe it's a mix of all these different things that Lawrence and Ryan were just talking about. Give us a look on our website, which is thesavvyinvestorradio.com. There's a button there that says the Income Analyzer. You want to know what your paycheck's going to be in retirement and how we're going to get there? Let's start right there. Let's get a phone call going. This triggers a 15-minute call. You can talk to one of our staff at Prostatis, and we'll sit down and talk about what your concerns are and how we may be able to help. That may lead to us sitting down in the office and saying, put the papers out on the table. Let's sit down and talk about my retirement and how I'm going to get my income that I need to do the things I want to do. Here's our number. Here's our website, 866-597-1040. 866-597-1040 or thesavvyinvestorradio.com.